Hey, what's going on, guys? Long time no talk. It's been a few months since I've done a video. Now I have a few minutes on my hand to go over what the Federal Reserve did. And I'll have a few more videos this Christmas holiday season, just a lot more free time on my hands compared to before. So, the Federal Reserve raised interest rates by 25 basis points, or somewhere between 0 and 25 basis points. Because you have to remember the original Fed funds rate was between 0 and 25 basis points. Now it's going to be between 25 basis points and 50 basis points. So this rate hike is not that huge, but still they are raising interest rates, which is a change from the Bernanke era. And what's quite interesting is that a lot of economists believe that they'd be raising interest rates in September. And I felt that they'd be raising interest rates in September. Other people said, hey, they do it in March. They do it in March. No. Felt that September would have been the time frame, but they didn't raise it. And that's because you had problems with China. And I was thinking to myself, okay, are they going to continue to postpone this, or are they going to raise in December? I was also thinking that, okay, the longer that they wait, the less credibility that Janet Yellen's going to have. So pretty much they were boxed into a corner, in my opinion, and Janet Yellen raised rates. But if you look at what her number two man said, Stanley Fischer, in interviews he kept on saying that they'd be raising rates this year for sure. They'd be easy, but at the same time they wanted to get the ball moving. They don't want to keep interest rates at zero for an extended period of time. So they are still very accommodative, or they are very loose when it comes to monetary policy compared to what people are saying that, hey, Janet Yellen's a hawk. She's not a hawk at all. But she is raising the interest rates by a little bit right now. And she may be raising interest rates next year as well. And what's interesting is that the economy is not at full employment compared to what the statistics are showing. I don't believe those statistics whatsoever. They're saying that the economy is strong. No, I don't believe that. There's still problems with their economy, a lot of structural issues, and they're still raising interest rates in this environment, which I find quite interesting because usually you raise rates when the economy gets going. What would have been better is if Bernanke started to raise rates in 2011, 2012, or even before then, 2010. That's where they should have been doing it. If they wanted to do by 5 basis points, 10 basis points, that would have been a lot better than what they're doing now. They're waiting 7 years into the cycle, and what they have allowed the U.S. government to do is they've allowed them to pile on all this debt, and eventually we know the chickens are going to come home to roost. Now you have to ask yourself, when is it going to happen? Because interest rates go up, cost of borrowing goes up for the U.S. government, and they're going to have a lot of structural problems in the future. Probably inflate their way out of it. It's just the timing of when they're going to inflate their way out of this mess. Getting back to topic. Other people may ask, okay, why would the Federal Reserve raise rates in this environment? And my reasoning is, well, you have to look at these pension funds. These pension funds have a lot of issues, underfunded. All these states continue to give out these benefits that these states cannot pay out to their pensioners. And the underfunded liabilities continue to grow. And if you look under GAAP accounting, these pension funds wouldn't be allowed to operate. But we don't operate under GAAP accounting for these pension funds. And they use phony accounting, government accounting. So what happens with these interest rates go up? When the interest rates go up, the idea is to help these funds that are very risk averse to try to get more yield out of this. And that's why, in my opinion, Janet Yellen is doing that. If you look at the state of Illinois, huge underfunded liabilities. If you look at California, huge underfunded liabilities. So, in my opinion, they did it because of that. Some other people say they're doing it because of capital flows. Because you have to remember that the U.S. dollar right now is continuing to strengthen. Dixie, what is it, like in the high 90s, close to 100? So you see the dollar appreciate. When you see the dollar appreciate, you know what? more times than not, you see all these investors pile in the dough into the United States economy, whether it's the real estate, the stock market, whatever. So they want to cool that off, in my opinion. In addition to that, the US dollar, I want to get into that. So, yes, the dollar index is close to 100. And I don't see it going up in a straight line. I mean, it went up from 79 to, 99 within the last year and 3 months, a year and 4 months. Well, the thing about the dollar index is it's a basket of fiat currencies, like I've mentioned hundreds of times. And 57% of the dollar index consists of the euro. And if you want to look at 11% of the yen. Now, these two currencies, long-term trend, will continue to be bearish, in my opinion. I mean, yesterday you did see the Japanese yen appreciate against the dollar. You also saw the euro index. It appreciated against the dollar. So those two big currencies, large composition, close to 70% of the dollar index, those didn't have the typical day of, hey, those two indexes are depreciating against the dollar. But long term, I still see that. Why? Because the Japanese and the ECB, they have huge structural problems, more problems than the United States. And with the United States raising interest rates, and you see those two countries being very accommodative or very loose when it comes to monetary policy, guess what? Dollar index will continue to go higher. And you know that like every 8 years or so they have a crisis in the economy. Tech bubble, 2000, 2008, real estate. What's going to be the crisis here? Some people are going to say pension funds. Some people are going to say that it's going to be a sovereign debt crisis in Europe. Some people are saying it's a Chinese bubble, whatever the hell it is. In terms of currencies, I still expect the Eurozone to go down. And the Japanese yen, that's the wild card, because the Japanese yen is the currency that funds all this risk and speculative activities in the economy. But you have to remember, a lot of these guys in Japan are doves. And with their debt to GDP ratio close to 300%, my opinion, when push comes to shove, even though they didn't raise any QE yesterday, they are going to be having more QE. They are going to be debasing the currency, in my opinion, more than the dollar in the short run. And it's just going to lead to a mess. You're going to see the yen continue to weaken, in my opinion. Short run, yeah, you're going to have times where the yen carry trade unwinds like we saw yesterday. And the Dow was down 367 points. But when push comes to shove, what do these central banks do? They hit the Control P button at any time. So, out of this, do I expect the Federal Reserve to continue to raise rates next year? And I believe that they will. And in addition to that, I feel that you're going to see the stock market, it could continue to rise, even though you saw some sell-off yesterday and the day before, is because you have central banks that could hit the Control P button at any time. The ECB, right, could do it. The Bank of Japan can do it anytime. Suppose you see the market go down to 15,300. In my gut opinion, you may see one of these central bankers flinch. And once you see that, boom, stock market goes up. Well, we should see what happens. Leave your thoughts below. I will probably do some interviews later on this week. And hope to talk to you soon. Thanks, guys. Talk to you later. Bye.